And today on the commodity derivative and currency derivative markets to talk to us about what we should be expecting, how should one be looking at the currency derivative market in association with MSCI. We're joined by Mr. Gaurang Somaiya, Forex and Bullion Analyst at Motilal Oswal. Thank you so much, Gaurang, for joining in with us on ET Now. And Gaurang, first thing I want to ask about, the volatility in rupee that is at a multi-month low. Now, this is making Indian corporates a bit complacent in terms of the hedging in their currency. Is that what you are seeing? What is your understanding here?
So we are seeing a bit of complacency coming in from these Indian corporates, and as you correctly mentioned, that yes, volatility has been at a multi-year low actually. We are expecting that these low volatility could still continue. So there have been this tussle which has been going on between the bulls and the bears. We are seeing that the rupee is getting supported because of the FIF flows, but at the same time there has been active intervention going on by the RBI. So this is again, letting the rupee curb a bit of losses as well. We are seeing that the FX reserves are close to over $600 billion. So all this is, kind of keeping the rupee quite stable overall.
Right. And Gaurang, if I want to just understand, what is your suggestion to corporates who are actually not participating or not hedging? What should they be doing? And could you just highlight in terms of the importance of hedging that and one benefits that one could as a corporate have for, by hedging in the currency derivative market?
I think one should be actually looking to hedge their position. See, what happens is that whenever you get a bit of complacent in terms of in an environment wherein the volatility is very low, people, kind of don't hedge their position. But we are still recommending that you should be going ahead and hedging your position, specifically for the importers, because the premiums are also low, which again is beneficial for these importers to hedge going ahead. Obviously, for the exporters, it's not a very lucrative, scenario because for importers, if the payment, premiums are low and payment will be beneficial. Similar is going to be the, for the exporters, wherein if premiums are low, they are not getting very good premiums. So we are, suggesting for exporters, they should be looking to hedge for short term, but for importers, they could be looking at a medium term perspective.
And Gaurang, just in terms of, if you want to understand from a perspective of a small business or an individual that wants to use the currency derivative markets or to hedge their currency exchange risk, what is it the possibility and what is the strategy one can use there? If you could just help us on an individual perspective or a small business perspective.
I think in terms of the individual perspective, it's quite case to case. Some sectors might be preferable to go in for those short-term hedging. But for some businesses, they'll obviously will have to look at longer-term hedging. So if I have to, kind of give you an example, for an infra company, it'll be better to hedge for a long term. But for those textile manufacturers or for chemical businesses, they will obviously will have to look at, hedging in the short term, because if they have to make their payments, they will, kind of not be able to take so much of risk because the margins are very low. Now, to give you an example, the month-on-month premium is close to 7 to 8 paisa, for example. Now, for an exporter, it's not going to be very lucrative if they are booking their forwards at this point of time. But for importers, it will be a good thing because they are paying less premium for that thing, and they'll be able to, kind of make their payments at a very low cost.
Okay, and if one wants to understand how can a corporate actually use the ETACD platform to hedge their forex, in terms of hedging, and what are the requirements there? How can they use this?
So obviously the exchange rated traded derivatives have obviously attracted a lot of interest in the last few years. But again, they have kind of been a resilient. So most of these bigger corporates have been a little resilient because you are not getting good volumes in the longer term tenure. So in the short term, obviously you'll be able to get those hedging, good volume obviously for hedging. But for in the longer term, you don't get so much of volume, and which is why they are hesitating. But yes, we are seeing that these smaller corporates are coming in. They are using these exchange or traded derivatives to hedge their currency risk. And we as a company have been very actively, advising a lot of corporates, to hedge their currency risk, even on the exchange and as well as on the off market thing.
And Gaurang, if I just want to understand currently, what is that contribution that could be coming in from these corporate hedgers in the ETCD market? What more can be actually done to get more of these corporates or enhance their participation in this market?
I think at this point of time, I probably might not be able to give you a number in terms of how much their participation is. But like I said, that there is obviously a lot of thing to be done in terms of the regulation side, or probably more people need to get on the exchange traded derivatives to increase the volume as well as bring in that participation. But on the regulation side, probably at this point of time, I might not be able to comment much on it.
Okay, and lastly, Gaurang, just want to understand in terms of, typically in the spot market, derivative markets, there's always a difference there. What is the potential that you actually see in terms of this ETCD market for India and other growth that we could see there?
Okay, I think in terms of the first spot and coming to the futures market, see overall the derivatives market has obviously been quite big in the last few years. We've obviously seen a lot of participation, a lot of new entrants have come into this market. But in terms of the hedging, as I said, that still there is a bit of hiccup which is there in the market. Spot market obviously it's much bigger as compared to what you see in case of the derivatives, because most of the big corporates kind of hedge their risk, their currency risk on the spot or with the bank, and which is why there has been a hesitation. But as I said, that there have been a lot of steps which are being taken by the government, by the RBI, to build up this market as well. So I'm sure going ahead in the near future, you will see this market also picking up specifically for the other major crosses, because for the dollar rupee pair, it's obviously a big market, but for the major other crosses, you will see a lot of participation also coming in.